here's the global situation summed up in a picture. Two biggest economies in the world. China, okay, we're a little bit worried that they're slowing or maybe falling apart. And on the opposite side of the equation, the US is going pretty well. So well, in fact, that they've been able to stop doing some of these weird monetary policy things that they've done for a while, and that actually might raise interest rates later on in the year. When you get the sort of divergence, people often get the jitters. Remember the Asian crisis, when Asia was in a bit of trouble and the Fed was raising rates. So that's an interesting sort of backdrop to have right now. And I'll make a couple of points about that. Well, firstly, keeping an eye on the US is incredibly important. For one reason, it's the biggest consumer base. It's a decent source of tourists for New Zealand, and those numbers are picking up. And the US tourists are one of the groups we really like. They're big spenders, so that's a good thing. But clearly what's going on in the US economy is really important for global interest rates. My starting point for working out what a 5-year mortgage is going to be, or the 10-year funding cost for a business, is what is the outlook for the US long-term interest rates. So the fact that they're starting to talk about raising rates in the States is on my radar big time for making forecasts for interest rates. Also, it's really important for the US dollar. New Zealand dollar's obviously come off quite a bit over recent months or over the last year. But around half of that is because the US dollar itself is actually firming against all currencies. Meanwhile, in the backdrop there, they actually, like a lot of the world, they don't have much in the way of inflation in the States, and I'll make a couple of points about that later on. But it's improving, which is good news for the world's biggest economy. On the other hand, our biggest trading partner and the second biggest economy is slowing, and you can read horror stories about China slowing down any day of the week. Now, there's one point that I'd like to make is China's actually been slowing for a while, and it needed to. It couldn't grow as fast as it was. And I don't panic too much if it's growing at 6.5%, 7.5%. I panic if it suddenly slowed down to growing at 3%. And I used to worry quite a bit about when it was growing at more like 12%. Those were the bad old days when a barrel of oil cost $150, which made life difficult for us. Now, big deal's been made about China slowing down and dairy prices falling away, and I think those are two quite separate events. The dairy price, to me, relates to inventories. I've plotted there what food prices have done, because we export more than dairy to China, and you can see the forestry guys have had a reasonably tough time too, but for the other things that we export there that the Chinese like to buy and put into their food chain, the prices have gone up. And it's pretty pleasing to see dairy starting to move into the right direction too, because I don't think there are many people in the world that could make milk at the prices they've got down to. One thing with China, it's very tough to believe the growth figures. It takes us 3 months to produce a GDP figure. They can have theirs out in a couple of weeks. So we always think about, well, this is what the officials are telling us. What do we think the real growth rate is? And I think it will keep slowing. One thing that they really want to do in China is they want to move away from this pretty bad mix of growth where the economy is really stimulated and driven by infrastructure investment. There's a lot of corruption and misguided investment that they're really trying to stamp out. And so it does mean a slower growth rate for China. The good news is what they want to drive growth is consumption, and that's the things which we export up to China. The very good news is, I think, is that the middle class in China is going to keep on growing, and that means a lot for our tourist sector. We'll chat about that a bit later on. Look, mix it all up, and here's what it looks like. It actually looks about average when I look at how are our trading partners going to be growing over the next couple of years. And I don't mean average like a teenager means about average, because that actually means really stink. I mean, it's actually pretty much like what we've had for the last few years. Growth about 3.5%, 4%. Now, the important thing, though, is the mix is changing. 5 years ago, China was growing phenomenally fast and the US was struggling. Europe has been struggling too. Now those developed economies are picking up, while the developing economies like China are slowing down. So there's always a risk with that. What if China slows down too much and America can't pick up the slack? What if America raises interest rates too fast and it really stuffs things up like an Asian crisis? But on the whole, I don't see the global backdrop as something I should worry about more this year than I did last year or the year before. What's a positive out of all of that? Well, one thing that's really positive is fuel prices. We've had this slightly below trend growth in the world at a time when we've had amazing investment in energy. And what I've done here is I've plotted, well, what does a global barrel of oil do if I convert that into New Zealand dollars relative to pump prices. And that underlying cost of a barrel of oil explains about 3/4 of what happens when you go to fill up a vehicle. I've also plotted there what the underlying financial market outlook is for the New Zealand dollar and for oil prices. This isn't my forecast, this is actually based on trading at the moment, so this is a hedging curve. And it's telling me that at the moment the market's factoring in that prices might rise a little bit from these levels but remain pretty contained. That's actually pretty cool when you think that the New Zealand dollar's dropped over 20% against the US dollar, yet we're still getting pretty contained fuel prices. It's feeding into our inflation as well. What's some other good stories about the global situation? Well, the economies that are going well and really growing, we're in the circle. When I went to university, one of the things we talked about was the tyranny of distance. We were a long way away from this circle, which people drew about Europe and America. It was expensive to freight our stuff to those parts of the world. That's where all the wealth was. Well, actually, 20 years later, it's a little bit more than that since I was at university, that circle slowly shifted to our part of the world. And look for us, 37% of global tourism growth is coming out of Asia. It's only about a third of global GDP, but it's over half of the growth in GDP. So that's good news as well. But for us, where it's helping us, those tourism numbers, a massive chunk of the student pool, and that's an industry that's going pretty well in New Zealand as well. Okay, so let's talk about some other things closer to home, cows and houses, and how all that global stuff affects us. Well, the first place where it affects us is in the exchange rate, and this is a plus and minus story for your industry, I suspect. The New Zealand dollar is definitely coming off. A big part of that is commodity prices falling. It's very hard, as this chart shows here, for the New Zealand dollar to stay really strong when commodity prices are under pressure. And if people have concerns about global growth, it makes sense that commodity prices come under pressure. So the New Zealand dollar's down, and we think it's going to probably keep going down whilst firstly there's concerns about the global backdrop, which are front of mind at the moment, and secondly, well, the RBNZ's cutting the cash rate. So in terms of vehicles, well, hey, it's good news for tourism spending. Tourism numbers, as I'm sure other people have touched on in the conference, are just going from strength to strength, but this is pretty tough on vehicle costs. I plotted it here against yen because I can get really good data on Japanese cars. What you tend to find is it takes a couple of quarters for that lower exchange rate to flow through. Parts, it just starts flowing through straight away because they're fast moving. But the bottom line is if we're forecasting the New Zealand dollar to stay under downward pressure against the yen and against the euro in particular, that clearly has implications over the coming quarters for the cost of things that you're importing. On the flip side of it, the tourism sector, it's our biggest earner of foreign currency or export receipts, and people, I'm sure economists are the only people that go, hey, where do I go for my trip this year? I'm going to have a look at an exchange rate schedule. Particularly Scottish economists like myself. But I think what most people do is they go, well, I've always wanted to go to New Zealand, but when they're only getting, when they're getting a lousy exchange rate because the New Zealand dollar is so strong, that affects how long they stay, how much they spend. They're going to have 20% more Kiwi dollars in their pockets for a number of our key tourists, which is great news for spending. So there's the tourism numbers there. There's the dairy numbers. You know, it is a pretty terrible couple of years for the dairy sector in terms of income, but tourism numbers. The naysayers are going, oh, look at the tourist numbers coming off now, but that's what always happens when you have a big sporting event, is that you scavenge visitor arrivals from either side of that big event, and I think those numbers are going to keep on picking up. There's a couple of key messages here. Firstly, we've got to be nice to Australians. There's going to be one day in the next couple of weeks where hopefully we're very nasty to them. They're nearly half of our tourists, as you can see on the chart above me here. So the numbers are actually sort of continue to pick up, which is great. But as a percentage, they're going sideways. As this thing happens over here, now the scales are different. So we're talking about 1.2 million visitor arrivals there out of 3 million, whereas China has now gone up to over 300,000, or about 10% of visitor arrivals. But look at that growth there. Okay, so those are tourists. I think that's a really great story. What about the population in general? So this is long-term migration. Well, we're sitting on record numbers of long-term migrants as well. Now, so this is both people coming here for the first time and people like me that were working in Australia that are now coming back to New Zealand. Both of those things are pulsing really strong. The other bit of tourism of migration is what about people choosing to leave? You know, some people come here and study for a few years, then they want to go home. Well, they're going home at a slower rate because there's opportunities here. And likewise, Kiwis, well at the moment, well I don't think we've given up on our travelling ways, but there's fewer Kiwis departing as well. And I think that's a big reflection of the strength of the Aussie labour market. You know, up to 30,000 people get sucked out to go to Australia. Net, that's actually not happening at the moment. That trans-Tasman migration is pretty much balancing itself out, which is quite unusual. And so I think a big part of this migration turnaround is going to be when the Aussie labour market starts giving some better signals. Funnily enough, even though we've created plenty of jobs, the unemployment rate's actually been rising. That's quite unusual. The economy grew by about 3% last year. It created about 3% more jobs, which is you know, tens of thousands of jobs. Yet the unemployment rate hasn't come grinding down to 5%, which is what you'd expect. I think it's actually going to go up a little bit more because we've got these strong migration inflows, and the economy isn't creating quite as many jobs as it was. But in terms of the number of people working, well, it's never been higher. Yet we've got the strong migration inflow, so it's kept a cap on general wages. Now, the one group of people that I've talked to that have said, hey, you know, you're telling me, looking at this chart, that wage inflation is only 1.5%, try hiring a truckie, and the wage has gone up by quite a bit, and I'm sure that's some of that tightness is affecting bus drivers and heavy transport drivers, because it's actually an area of skill shortage. Partly relating to the Canterbury earthquake. So that broader wage inflation story, I don't know whether that's going to be the case for some of the specific roles where I think there are some skill shortages in your sector, but that is the general backdrop that the economy is operating under, this low inflation, low wage growth environment. What it does do is it makes customers very sensitive to price increases if the general populace isn't getting much of a wage increase. Inflation might not be very high and wage growth might not be very high, but house prices are, and I think that's probably going to continue. I think house prices in terms of growth are probably peaking about now, but it's very hard for me to forecast house prices to fall when you've got ongoing employment growth and record population growth via migration. Check this out, Auckland housing affordability. So this is a average wage relative to an average house price. Now in the long run, houses should cost 4, maybe 5 times someone's salary. At the moment in Auckland, that number's approaching 10. So this is quite a different story in Auckland relative to the rest of the country. Areas like Wellington have actually got more affordable on the back of these low interest rates that we've got at the moment. Another way of looking at it is how much of your income would an average household income have to go towards paying the mortgage, and it's well over half in Auckland. It's only these record low interest rates that are meaning that it's not the most unaffordable time ever. Mortgages, on the other hand, okay, well they're going to head lower, which is amazing when you think, normally we kind of think, okay, well when the housing market's going crazy, the Reserve Bank cranks up interest rates. Well, their concerns with the housing market are about financial stability, and that's why they've got these lending restrictions in place. Their interest rates are set for inflation, and I'll talk about that in a minute. So we're picking that mortgage rates can actually get even a little bit lower, not too much lower. For funding costs for businesses, this has some similar implications. And I'll talk on our actual Reserve Bank outlook in just a minute. Other bits in the economy that are good, consumer spending growth, it's actually holding up really well. 6% or more annual spending growth. So the retail sector should be reasonably happy. And if that population growth continues via the migration channel, it's really supportive for retail spending. Business confidence has fallen off the face of the earth in the last couple of months, and you can see in this chart on the right, employment intentions and investment intentions. Now this is the ANZ monthly survey, which has kind of gone a little bit AWOL lately with this big plummet. If you look at the NZIER quarterly survey, which has run for a lot longer, it's not sending quite as bad signals about businesses' intentions to employ and invest and their general outlook. But it is pointing, both surveys are pointing to a slower pace of growth over the next year than what we've had in the past couple. So we've grown at over 3% in 2014. I think it's probably going to slow down to about 2% over the next quarter or two. And that's that in a chart. But the lead-in for the next growth phase is always easier monetary conditions. You've got lower interest rates, you've got a much lower New Zealand dollar. It takes about 18 months for those things to stimulate the economy. So I'm not getting overly bearish, even though you see quite a few negative headlines about the economy at the moment. I think we need to be careful what we wish for on this front. Even if we're growing at 2%, that's a growth rate that much of the world would die for. Europe's not growing that fast, Japan's not growing that fast, America's growing that fast, but that's after years and years of subtrend growth. The toughest thing for the government is these years of nearly getting there to returning a surplus are possibly going to hang around for a while longer because of this lower growth that I'm talking about. Couple it with this really low inflation that we've been chatting about a bit, that's actually a real headwind for the government to return to surplus. So what does that mean? Well, we've got that land transport plan, which was pretty good. I think most people were pretty pleased with the amount of commitment that the government's had to roading, but I don't think that there's going to be a last-minute lolly scramble before the next election, because I think the books will be too tight, and the government will want to stick with the pattern they've been playing for a while now of really being committed to returning to surplus. Okay, so the RBNZ, so their first job is price stability. It's not to control the housing market, and inflation at the moment is running at about 0. We get a new inflation figure out next week. It's probably going to be running about 0.3%, which is pretty close to 0 when you think the Reserve Bank's job is actually to maintain inflation at around 2%. So it hasn't actually been anywhere near their target since back in 2011. That's quite a long time to be missing your inflation target. So in that environment, well, what do? You put the lending restrictions in to try and control the housing market and maintain financial stability, and you cut the OCR. So we've got rid of 3 out of the 4 hikes that we had last year. I think they'll get rid of the next one. There's always a question mark as to when. And I really struggle to see how we can get back towards 2% inflation unless they cut it by even more. And hey, the economy could get some positive shocks from other areas that make it grow a bit faster. But I actually think the risk is that the Reserve Bank cuts the OCR even lower next year. Well, from a hedging perspective, if you're hedging loans, the fact that there's record low swap rates at the moment should be telling you something about what to do in terms of hedging your borrowing. And I always think with mortgage rates, it's not all a function of what the Reserve Bank does. Recall last year the Reserve Bank was hiking the OCR and long-term interest rates were falling. Well, if the state starts hiking interest rates, the Reserve Bank could be cutting the OCR and our long-term rates could start lifting. So if you're looking at hedging, don't just hang around until the moment that the Reserve Bank finishes their tightening cycle, because the lower rates might come before then. So I'm going to wrap up there. All right.
Thank you very much, Chris, for your words of wisdom. I would say New Zealand's in pretty good shape.